Good morning. Today we're going to cover 3 or 4 pages out of chapter 6. It's a short day. It focuses on management assertions. It's a very, very important day, a very important lecture. Our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free of material misstatement, whether due to fraud or error. We've already talked about materiality. It's a vague, ambiguous word. Now we're talking about reasonable assurance. Reasonable assurance is a high but not absolute level of assurance. The world you're going into is full of judgment, subjective judgment. I couldn't live in that world. I've got a defined benefit pension plan. I had tenure before I retired. I've got a solutions manual. Your world's not going to be that certain. So I've lived in a very certain world. You're going into a very uncertain world. Materiality, reasonable assurance. These are all judgments. I would not have been a successful partner. I'm too risk averse. The audits I was on, I never thought we had reasonable assurance. I was too risk averse. You have to be able to accept a level of uncertainty and move on. So reasonable assurance, you need to know what it is. We're only going to talk about the 6 assertions in the upper right-hand corner right now. Later on, we'll come back and pick up the rest of them. But all we're worried about are the 6 in the upper right-hand corner. Notice there's a column for transactions and there's a column for balances. And the reason for that is we audit transactions different than we audit account balances. Many years ago, I got to teach audit fundamentals for KPMG. It was a fantastic experience. They had a slide that looked something like this. I asked them if I could have a copy of that slide, and they said no. So as best I could, I committed it to memory and I made my own. The important thing that I'm trying to get across here is KPMG says we audit transactions different than account balances, different than estimates, different than disclosures. So if KPMG were to make the chart on the previous page, they'd have 4 columns. They'd have a column for transactions, a column for account balances, a column for estimates, and a column for disclosures, because they audit them differently. We're going to talk about audit objectives. So we're going to learn the assertions. Management asserts that all the sales on the income statement really occurred. Management asserts that all the expenses on the income statement, that all the expenses that occurred are included on the income statement. Management asserts that the inventory really exists. Management asserts that all the liabilities have been recorded on the balance sheet. So that's what assertions mean. Management is making assertions about. We're going to turn those assertions into objectives. So significant class of transactions. We only audit significant classes of transactions. We're not going to audit every class of transaction. We're going to audit significant classes of transactions and significant account balances. We're looking for related accounts that we can put together to create a cycle. What do we mean by a cycle? Well, here's a list of significant transactions: sales and cash receipts, cash disbursements, payroll. I hope you'd agree that those are all significant. We're going to work with sales and cash receipts this quarter. So we've got credit sales and cash receipts, revenue and collection. We're going to put them together and call it the revenue and collection cycle. Accounts receivable sales is a class of transactions. Cash receipts are a class of transactions. We're going to put them together and call it the revenue and collection cycle. Why are we trying to get a cycle? Well, think back to 214. Y'all learned the accounting cycle. Assets equal liabilities plus owner's equities. There were a bunch of questions we always ask. If assets equal 100 and liabilities equal 80, how much is owner's equity? If owner's equity equals 80 and liabilities equal 20, how much are assets? The point is that if you know information about two, you can solve the third. So we're looking for relationships in accounts where information about two will give us information about the third, or information about three will give us information about the fourth. So if we look at a sales journal, this goes back to the day of paper and pencil. And instead of making journal entries, they could save time by creating a sales journal and just recording the transactions as they occurred. And then at the end of the week or the month, they could post the total to debit to accounts receivable and credit to sales. This was done in a paper and pencil world to save time. Everybody still has a sales journal. It's done entirely different inside the computer, but we still refer to a sales journal. Companies use a cash receipts journal. And let's assume that the only source of cash receipts for the company are accounts receivable and sales. Is that totally true? Not quite. But for most companies, most cash receipts are the result of accounts receivable. So we're going to take the total for the week or the total for the month, and we're going to debit cash and credit accounts receivable. Now, as soon as a company has a cash receipts journal, that means they've split cash into two accounts. They split cash into cash receipts and cash disbursements. They effectively become two different accounts that they put together at the end of the month for their balance sheet. But from a control perspective, they're two accounts. This is a powerful control because this way nobody knows exactly what that balance should be. So it makes it more difficult for the person in charge of cash receipts to steal, or the person in charge of cash disbursements to steal. It makes it more difficult for them to cover their tracks. Now look at sales. You can argue that sales has a balance, and yes, it does. But the balance in sales is entirely different than the balance in accounts receivable. The balance in sales is comprised of all the transactions that occurred during the period. In order to audit sales, you'd have to audit all of the transactions that occurred during the period, and they're difficult to audit. Unlike inventory, I can't go observe sales. The sales that occurred in January and February are gone. We can't see them. We have documents to support them, but we can't see the actual transaction. Accounts receivable or inventory or balances, on the other hand, represent what's left over. So if we think about accounts receivable, we've had debits to accounts receivable, credits, debits, credits, debits. And what we have left over are probably the last 30 or 45 days worth of sales. So accounts receivable are easier to audit than sales simply because accounts receivable are simply what's left over the last 30 or 45 days as of December 31st. Now, cash receipts, if we split cash into two accounts, cash receipts are transactions, but they're easier to audit than sales because the bank, an external third party, sends us a letter every month and tells us what our cash receipts were for the month. So it's fairly easy to audit cash receipts. Now, due to the relationship of these accounts, if the only cash received by the company was due to sales, either credit sales or cash sales, then if we knew the cash receipts and we knew the change in accounts receivable, we could determine what sales should be. So this is a case where we've got three closely related accounts, and information about two gives us information about the third. Information about cash receipts and accounts receivable will help us audit sales. It will make the audit of sales easier. Now again, my favorite table in the book, table 6.3, here are the management assertions that we're going to worry about through the first test. Now, we're going to have to tweak them. We're going to turn them from assertions into objectives. The assertions are generic. Any transaction or any account balance. Now, we're going to audit sales and accounts receivable, so we're going to have to tweak the assertions and make them more applicable to sales and accounts receivable. Okay, so the book goes on and it talks about transaction-related audit objectives for occurrence, completeness, and accuracy. Those are the only three we're worried about right now. We'll come back later and pick up classification, cutoff, presentation, but right now we're just worried about those three. Think about what a sale is. What does it identify? A contract. So our refrigerator broke recently and Patty had to go buy a new refrigerator. What was the contract? In this case, it was a sales order. She went to Idler's and bought a new refrigerator, and there was a sales contract. It was the sales order. You give us the refrigerator, we'll pay you for it. Now, the performance obligation was pretty easy. They agreed to deliver a refrigerator to us. The transaction price was fairly cut and dried. It was right there on the sales order. How much are they actually going to receive? Well, they knew the answer to that question because they took our credit card, and I'm sure they ran it through and made sure that we could pay it. There was only one performance obligation here, so we didn't have to allocate the transaction price. They weren't allowed to recognize revenue until they actually delivered it. So think about what a sale is. We've got an agreement, we've got a customer, we deliver the goods. So the book on page 169 shows us some audit objectives derived from the assertions. For occurrence, it's recorded sales are for shipments made to real existing customers. So idlers couldn't recognize the revenue until they delivered the goods to us. Completeness. All sales that occurred have been recorded and included on the income statement. Accuracy. Recorded sales are for the correct amount of goods shipped and the correct price. So all they did was take the general assertion and tweak it a little bit for sales, and then it becomes an audit objective. Balance sheet, similarly, we're only going to worry about three: existence, completeness, and accuracy, valuation, and allocation. Think for a minute. If our objectives are based off of management assertions, then what will we have to do to achieve our objectives? For each and every significant class of transactions, or each and every significant account balance, we must obtain evidence to support every management assertion. Does that make sense? So we're going to have to obtain a lot of evidence for each assertion, for each and every class of transactions, and each and every account balance. We're going to need evidence to support that assertion in order to achieve our objectives. Inventory is easier for me to think about than accounts receivable. Okay, so here's my assertions: existence, completeness, accuracy, valuation, and allocation. And the book says for existence, my audit objective will be all inventory reported on the balance sheet exist as of December 31st. Completeness is all existing inventory has been counted and included in the inventory balance. Accuracy, valuation, and allocation. Inventory quantities on the client's perpetual records agree with the items physically on hand. So we take a physical inventory and the counts agree. Prices used to value inventory are correct. Extension of price times quantity is correct. Okay, so pretty straightforward. Now, if we jump way ahead on page 557, table 16.4, it shows the audit objectives for accounts receivable. Existence. Accounts receivable on the aged trial balance actually exist. What's that mean? They're real claims. The company has real claims to that money. Completeness. All existing accounts receivable are included in the aged trial balance. Accuracy, valuation, and allocation. Accounts receivable are reported at net realizable value. Remember, we report accounts receivable at net realizable value. Let's think for a minute what we've learned. We report investments at market value in most cases. We report accounts receivable at net realizable value. We report inventory at lower of cost or net realizable value, or lower of cost or market if the company uses LIFO. We report property and equipment at their cost less accumulated depreciation. So those are valuation accounts. Audit evidence. The objective of the auditor is 1, to design and perform audit procedures, 2, that will enable the auditor to obtain sufficient appropriate evidence, 3, to be able to draw reasonable conclusions, 4, on which to base the auditor's opinion. Professional skepticism. This is a big thing nowadays. 3 parts: an attitude that includes a questioning mind. 2, being alert to conditions that may indicate possible misstatement, whether due to fraud or error. 3, critical assessment of audit evidence. So that's a biggie, and that's a thou shalt know for the first test. Be safe until we meet again. Have a good day.